everyone. So we are a new age investment services firm. So two things we do really well. One is wealth management and second is content and analysis. Our ethos is informed investments. In line with our ethos, today we have this webinar and we have two experts, Mr. Prashant Khemka, who is the founder with WhiteOAK Capital Management, and Mr. Bharat Shah, who is the ED with ASK Group. Both these experts are, timeless experts of equity markets. And today we are in an unprecedented scenario where investors have two questions which are unanswered. It is a very confused state of times where equity markets are just on their new highs, but economy is definitely on downtrend. Everybody around us seems to be very negative and bearish, but equity markets are just, not discounting that. So investors are confused whether they should be investing at these levels or they should be exiting and booking profits at these levels. So these are tough questions. And to answer these tough questions, to get answers to these tough questions, we have Mr. Neeraj Shah, who is chief editor with Bloomberg. Over to you, Neeraj, and over to you guys. Look forward to a very great discussion and on getting answers to these two unanswered questions, especially from client's perspective. I would just request both of our speakers to put yourself in the client investor's shoe and try and answer from his perspective, because the situation is absolutely real. And I can tell you, because we do the client side, I can tell you investors are absolutely in confused state. Investors are not able to get answer to these two questions. Over to you guys. Thank you.
Thanks, Kamal, for that. Prashant, Mr. Shah, good talking to both of you. Let's start off this conversation with the most obvious thing, right? That this event is unlike all the preceding ones. Some totally new, no near-term or no near certainties, merely strong possibilities. So therefore, I want to start with what we're seeing in the last 45 days or last 30 days, which is a strong rebound. Prashant, what's your sense? Would you, as somebody who's investing public money, bet the entire house on a V-shaped recovery? And is that prudent, or would you believe that there is ample logic in trying to not be fully invested currently?
Thanks, Neeraj, for the question, and thanks PMS AIF for organizing this, and thanks all the participants for sharing their evening and joining us today. So the two aspects of your question, Neeraj. One is betting the house is, as you mentioned, or putting all your investment at this point in time. And the other is V-shaped recovery. My view, even if, so one does not need to be a V-shaped recovery for one to necessarily make investment in the market, I would say that. But dealing with one at a time in terms of V-shaped recovery, at least economic recovery, hard to say. Things are very fast evolving. You mentioned yourself, it has been, and to state the obvious, which is it has been an unprecedented situation with very high degree of uncertainty. Having said that, I think with each passing day, it feels like the range of possibilities is slightly narrowing, even if slightly. So let's say 2 months ago, the range of possibilities seemed a lot larger. The risk of, there's a lot of unknown out there, but the risk of that unknown, if you will, seemed much, much higher, as someone put it, than it may be today. As of now, the liftoffs are happening of the lockdown. So from a market's perspective, market doesn't have any emotions or sentiments. So the virus itself and the humanitarian loss caused by it, that itself wasn't as much of a worry to the market at any point in our view, as the economic cost of the lockdowns that were implemented to contain the virus. Now that, so let's say 2 months ago when lockdowns were first implemented, 2.5 months ago lockdowns were first implemented, it was unclear for how long and to what end and what purpose these lockdowns would last. Would they last for 18 months till a vaccine is found? Would they last for many quarters till some solution is found? And that posed a fairly high and uncertain risk to economic growth as well as corporate earnings. And now with the lockdowns being lifted, the risk to economic growth and corporate earnings has subsided. And that is why the markets are recovering fairly sharply. There is a certain assumption with a high degree of probability markets are expecting at this point that the lockdowns would not be reimposed. And if the lockdowns are not reimposed, then at least the economic cost would be less than what might have been feared a couple of months ago. And hence corporate earnings loss might be somewhat lower. And that's the reason for market recovery to be more of a V-shape, even if the economic recovery might end up being a more prolonged one.
Mr. Shah, good evening. What's your thesis? And would you believe that while all the points that Prashant makes are pretty logical, the question is what now? Now that we are no longer, from an Indian markets perspective, at 7,500 but at 10,000, from an S&P perspective, at near about the levels from where we started out the year, what should investors do now? What would you do now?
No, so what is the question?
My question is, what do you think the time ahead, the next 6 to 12 months ahead would be? Because there's a lot of uncertainty. Would you believe that there is merit in staying invested, making fresh investments because of the uncertainty, despite the uncertainties? Or would you be cautious currently?
No, but when do you know of a market when there is no uncertainty? Which phase of a market do you know when there are no uncertainties? Sometimes more, sometimes less. Without any doubt, there are more uncertainties today than at most other times. But investing is all about uncertainties. Life and investing both have uncertainties. And the day those uncertainties crystallize into mathematical certainty, life loses charm and investing loses potential. So uncertainty is a part of the investing, which will never disappear. So I don't know if you are saying from a perspective of 6 or 12 months, we all can opine, but what can we exactly opine? That will be like forecasting short-term phenomena without having any adequate basis to make those short-term predictions. So we all can attempt to make those predictions, but will not have any necessary ring of truth about it. And therefore, these are all attempts to time the market, or attempts to try to sound, so to say, more certain about what essentially is an uncertain near-term future. So all I can say is what we think of it, but whether that is to mean the same thing for everybody, I don't think we can utter profound truths of a kind which applies to everybody. Essentially, in the near term, it is clear to everybody that near-term earnings are impaired, in some cases more, some cases less. It is purely mathematical. When you shut down businesses, your expenses remain either same or little lower, but your revenues are crunched down for a shorter period. Current year is a year of maybe 9 months, 9.5 months in a 12-month period. Last year was 11.5-month period in a 12-month period. So clearly earnings are going to get impacted without any question. So that doesn't require any, any light to be thrown about. It is a certain that near-term earnings are impaired, in some cases more, in some cases less. Some special cases will still have earnings growth for some special reasons. But in general, there will be an impairment of the earnings in the near term is a certainty. We have to look beyond. And as Prashant, I think, alluded to, markets are not in a business of passing moral judgments. He didn't say so in so many words, but he kind of implied. So it is more than anything else. It's not really disease per se which has caused markets to go down. It is the economic impact. If the economic impact is recovered the earlier, so will be the markets. And the earlier statement right at the beginning was that markets have bounced and they've gone to new high. Factually, that is completely incorrect.
No,
Markets
I didn't say that.
declined.
No, I didn't say that. I mentioned the S&P 500 is back to the levels from where it started the year.
No, not you, but I think the other gentleman who began,
Okay.
he
Okay.
mentioned that. So which is factually incorrect. Markets declined very badly, and then it has staged a recovery. In case of America, probably markets have recovered all of the ground. In India, markets have
Yes.
still probably 18-20% down from where they were at the beginning of the year. So markets have declined, but making any of these near-term predictions about timing, about trying to gauge the sentiments, about trying to make meaningful conjectures of whether it will be V-shaped recovery, what we should do, I don't think is the most important questions to answer. Really speaking, if you can think of these challenge is a near-term challenge, but not a permanent challenge, then I think there are answers on the table. I believe that this is not a permanent challenge. There will be some impact on the earnings. On the other end, therefore, it affects value. When there is some near-term earnings impairment, it changes the value. It reduces the value of a business today. On the other end, there is a margin of safety because prices have fallen sharply. Therefore, there is a margin of safety. So there is a positive in form of margin of safety. There is a negative of an impairment of near-term earnings. But on balance, I feel margin of safety-led benefit is much higher than the impact on the value because of the short-term earnings impairment.
Okay. So let me ask this as a follow-up, Mr. Shah. Do you see margin of safety market-wide even currently? I mean, sure, there will be specific pockets every single time in any scenario, but market-wide, larger investment universe, do you find margin of safety even now? And two, do you still maintain your investment style currently as compared to what it was in the past? Because I understand that the markets are always uncertain, just that a lot of people feel that the level of uncertainty is a lot higher right now than what they have experienced in the past.
Yes, that is what a lot of people may find that they are experiencing uncertainty a lot higher in the past. But if you look at the history of the cycles of the market, this is nothing very unusual. Every time in each new cycle, causes may seem to vary, but the impact on the impact in the markets and the behavior of the participants, both of them remain constant. Behavior is every time predictable as to what will happen when the markets go through the downward spiral in a sharp way. Impact on the market obviously is easy to see when that happens. It is the causes which seem to vary, but the cycles remain both on the downturn as well as on upturn. It is only the causes which change. The rest of the things remain the same. So that's first point. Second, whether I see value in the large pockets of the market, I'm actually not interested in large parts of the market. I'm interested only in some parts of the market. There is a large part of the market in which neither I had interest in the past nor I have interest today. And it is unlikely that I'll have a lot of interest going forward. Investing is not a democracy where everything has to be given an even chance. Investing is about exclusion. And to that extent, large sort of businesses are such which don't deserve your attention. They don't deserve your time. And to that extent, you don't have to find necessarily virtues or values in the large part of the market. But of the kind of the pockets that I like, the businesses which have inherently a character to compound, businesses which represent superior quality of the growth, superior character in form of efficiency of the capital, and the businesses which are run by people whom you can trust and depend upon, and the businesses which have pedigree, which have proven themselves over a fair period of time, and they represent to hold out their promise in the future. And if I find value in those segments, that is more than satisfactory as far as I'm concerned. So that's how I would look at it. And as far as those pockets are concerned, even those quality businesses representing sound balance sheets and sound businesses, which otherwise usually remain expensive, there is a value available in many, many parts of that. So that's on the second part. Yes, so there's the third part of, sorry, I forgot what was the third part that you raised.
Now, I was essentially asking you about whether you believe that, or the large portion of the investing world believes that the uncertainty is so high that maybe there is merit in not being fully invested right now. Because while you may like your businesses, which may stand the test of time, market coming off as a whole, if it does, will impact the valuations of your business too, or the
No,
businesses that you like as well.
Of course. Look, nobody can shy away from the fact that there are challenges. Secondly, nobody can shy away from the fact that markets are impacted. That is simply because businesses are impacted in near term. Thirdly, nobody can shy away that there is a greater uncertainty at this point of time than usually you find in the market. A 10% drop, 15% drop in the market is even Stevens. That is part of the character of the market. Time to time, 10, 15, 20% of the changes in the market composition character will keep occurring, whether up or down. Nothing very unusual. This one is spelling greater uncertainty. Nobody can kid around on that fact. But what I am trying to say is, once again, the same thing. We have to distinguish between what is a temporary or a near-term challenge compared to something which is permanent one. Second, when even if there is something which is a longer-term impact, whether it is a material impact, is equally an issue to be answered. Now, when I look at this situation, if something is materially impacted, then also we should be concerned about. If something is impaired on a long-term basis and by a fair margin, that also is something to be contended with, because that will have impact on the value. But if something is impactful, but in a near term, then in a course of a long-term future, the impact of that near term is not as disproportionate as it may sound to the minds of people. Human mind is suffering from a recency bias. It suffers from near-term prejudice. So when there is a near-term uncertainty and a sudden one of the kind, because out of the blue, a shock like this has come, therefore people are bound to feel impacted, and nobody should blame anybody for that. Everybody feel, even today, can I say that I don't feel afraid when I put in fresh money to work? When we lived through March month, which was like a crazy month where there were terrible kind of drops in the prices. It will be dishonest on my part to say that when I'm putting fresh money to work, I'm not suffering doubts or I'm not suffering heart palpitations. That is part of the nature. You all go through that worry, because the day you lose all the fear, then you start doing reckless things. So there is a fear, there is a worry, but at the same time, you constantly have to reconcile the stress between what you believe the future is and what may be present reality. If you believe the future is where it is, and present reality may not reconcile with that, but you believe about the future, then that's where you have to put your money, and that's where your mouth has to be. And to my belief, this is important challenge, but a short-term challenge. It doesn't alter businesses on a fundamental basis in a negative way. And in fact, there are businesses which are going to gain out of this COVID challenge. And therefore, there are other benefits we are ignoring to the exclusion and focusing way too much on the negativity. And when you take a sum total of it, with all the fear, with all the uncertainty, with all heartbeats at time going up and down, I still believe this is a time to invest. If you have long-term view, if you have patient capital, if the capital is there for at least 3 to 5 years, rather than 6 and 12 months, and if that capital is backed by a mind and a heart which is going to balance between a fair fear and distinguish it from irrational fear, then I think this is a very good opportunity.
Okay, and I'll come to some of those points as well. Let's not focus only on fear. Let's focus on opportunity as well. But Prashant, let me get you in on an argument which also is not wrong. I mean, one looks at the valuations that MSCI India, for example, trades at, the kind of returns that the markets have given dollar terms for the last 3-year, 5-year, 10-year period as well. Why should somebody who's investing right now believe that what's happened in the last 3 to 5 years will not happen in the next foreseeable future, especially when the economic realities are harsh right now?
Certainly, Neeraj. So, as you very well know, in equity markets, not appropriate to extrapolate the past, and there is great tendency, as Bharat Bhai mentioned, the recency bias of extrapolating the recent past. So it is true that over the last, why just 3 to 5 years, over the last decade, Indian equity markets not delivered much return. I mean, in rupee terms, it's been low to mid single digits. In dollar terms, and in fact, fiscal 10 to fiscal 20 dollar terms return has been slightly negative. But does that mean anything about the next, next year or next whatever time period, year, 3-year, decade? No, it means nothing. I mean, if you, in fact, look at the prior decade, which was one of India's best decade, it delivered low double digits, in fact, 13% or 12 to 13% return in dollar terms on the back of similar earnings growth. So just as
Prashant, if I may, the only reason why I asked this question was that a lot of people make this point when I hear some of the global conversations and the global guests who come on the platform. They make this point about the starting point being so important. And from their perspective, India at 1920 times, with the returns not having been great, would there be a gushing reason for people to come in and invest in India? That's my point. And we'll get to the opportunities. But I just want to get this point because a lot of people fear that liquidity propped up rally might come off. What's the argument against that?
Certain. So thanks, Neeraj, for the clarification. See, the valuation question has been, there for last many years. And always is there. I would say all valuations globally are benchmarked and are relative to the US long bond, call it 10-year, 30-year bond or whatnot. So when people peg themselves to a certain valuation range, it is again with a certain amount of recency bias, if you will. In mid-90s, when I went to the US to study, the long bond rate was 6 to 7%. 10-year was 6%, 30-year was 7%. If you were to inverse the bond yield for US, the multiple for the bonds were 14 to 16 times or 14 to 17 times. At that time, the S&P 500 in the US was also trading at 15 times multiple in line with. And then all the other equity markets worldwide, depending on various factors, including growth and sustainability of that growth, and all would trade at a bit of a premium or discount. Today, if you see, the US long bonds are trading at 1 to 2%. The 30-year is at 1.5%. So effectively, the bond multiples gone to 60, 70 times or something. And the S&P multiple in the US is still at 20 times. So it has expanded, but very little. I'm not suggesting it should go to 50, 60 times. But you have to keep in mind the context. The discount rate has gone down everywhere in the world. In the 90s, when I was starting my work in US equities, investing in US equities, we used to have risk-free rate of 6%, and then used to debate whether the risk premium should be 4%, 5%, or 6%, for a total discount rate of 10 to 12%. Today, the same debate has gone down to risk-free rate being 2%, and whether the risk premium should be 4 or 5%. The overall discount rate has come down a lot more than the growth has come down. Yes, the growth has come down. So for valuations to correct worldwide and in India in a step function manner, bond yields, in my view, might have to go up. And bond yields are where they are. That's the second part of your question. Is it all the liquidity that is fueling the bond prices and the lower bond yields? I think that is exaggerated cause and effect. or correlation, if you will, there could be other stronger reasons at play, and that is basically death of inflation. In current world, most governments, not most, but there are several developed world central banks which are more concerned about deflation or no inflation than there are about rising inflation, which was the case again decade or two ago. So when inflation expectations are so low or non-existent, it is reasonable to have very low bond yields. And when bond yields are to be so low, then the discount rates will be lower and hence multiples are higher in our view.
Okay, we're just getting a small echo. I would just urge if to both Prashant and Mr. Shah that if you can mute your video, if possible, when you're not answering, it'll be really nice, just so that the echo doesn't quite come in. But Mr. Shah, let's work with an assumption that, oh no, Mr. Shah, we lost your feed. Yeah, okay, now we have you. Great. It would have been tragic to lose you here. Let's get you in this, your thoughts, Mr. Shah, on the point that you mentioned. Both you gentlemen and your firms have fantastic track records. So you obviously know how, when to invest and what kind of businesses to go in. You mentioned opportunities because you mentioned that we focus a lot on the problems at hand and not so much on the opportunities at hand. Would you want to talk about it from an Indian investor's perspective? Where do you see opportunities in the post-COVID era?
Yeah, at three levels. There are some near-term gains to be had. Then there are more medium to long term. And then there are structural long-term gains as well. Let me deal with the near-term ones. Oil price benefit is a clear one. And to that extent, there'll be savings in economy as well as in the businesses of varying amount depending upon where things are. But there is pretty little doubt, without being expert on oil and gas, but there is going to be a fair bit of savings to be had on that count. Then there are a lot of intermediates, raw materials, some petro-based and others where the prices have come down. And to that extent, there is also a benefit to be had on that account. I think on the agriculture front, we would have some positive and definite positive account, not just from a near-term basis where on the record last year's output, I think we are headed for another all-time record probably in this year, going by the sowing pattern and probability of the monsoon and all of that. In these difficult times, this advantage should not be discounted. And more importantly, I think there are fundamental reforms announced. One of the most powerful ones, if these reforms indeed find roots and happen in terms of dismantling of Essential Commodity Act and APMCs, essentially, and pricing freedom, apart from corporate contract farming ideas, these are really very vital changes over a period of time. So this is one set of advantages. Then there are important midterm to long-term advantages. One is the decline in the cost of capital. I think the battle on that has been won with a fair amount of discipline. Over the last few years, India has been fiscally and in terms of the current account deficits, both have been disciplined despite our resource constraint and challenges. And we have not easily tried to dilute that discipline which has been visible in last few years. Therefore, rupee has been relatively more stable than what it could have been, and certainly was in the, if you leave aside last 5-6 years, if you look at prior period, the rupee behavior is quite clearly visible. Also, in terms of the inflation has been structurally tamed. Therefore, cost of capital has come down. This is material advantage from two perspectives. One, for the users of the capital, their profit and loss accounts improve. Other is for the investors in the assets, because any drop in the measurable, which is what I think Prashant was trying to refer to when he was talking of the bond yields and equity yields kind of comparisons in his earlier dialogue. Essentially, any significant and predictable long-term decline in the cost of capital would have a bearing on the value of the equity assets, which has to be borne in mind. Second, I think, is the digitization. I think demonetization first sought to kind of bring in that digitization. Our Aadhaar-led DBT and all of that is really made it a strong impact, and many more things to be done. GST also was actually in the similar category. And then we witness other reforms like RERA and a few others. So digitization, I think, is going to get a real impetus. Businesses which could have been fully digitized and have not, I think, will find a chance to do so. Businesses which can only be partly be digitized and not fully, but they've not been as much digitized as they could have been, again will have a chance. And these greater digitization would have implications for productivity, reduction of the cost, and improvement in the scalability. These advantages should not be underemphasized. And always there are moments of this kind which nudges and pushes the society in a desired direction, which otherwise would have taken time. Third, I think, is what will happen to the stronger businesses in every sector compared to the weak or very weak businesses. Every such challenge gives an opportunity for strong and good businesses to come out of the challenge and eventually become much stronger and bigger and better. And therefore, this opportunity also will eventually show that good businesses not only will gain the sector or the underlying core growth, because they are good businesses, they'll get a greater growth than the sector will be able to generate. And because some of the marginal and weak players either will be neutralized or decimated, they will get the growth even of that. And therefore, a lot of good businesses will improve. That has an implication for improvement of the capital efficiency of the overall system. Because when you destroy bad capital and promote good capital, overall capital efficiency of the system rises. And therefore, that's where the improvement in the value of the businesses comes by. Third is, I think, specific businesses where you can see where already there were good businesses and they will get better because there are favorable tailwinds. Insurance, for example, health insurance, general insurance, life insurance, all will get revisited, even though there are near-term impact because of the shutdown. Then pharmaceutical, healthcare, diagnostic chains, even though there are temporary physical disruption, long-term there are favorable tailwinds. Then look at the businesses in chemistry area, specialty chemistry, active pharmaceutical ingredients, active agrochem ingredients, areas where India is a strength. Some amount of outsourcing was already moving away from China from 2017. But I think this COVID event will give some further impetus. Nobody is saying that China will get replaced and all that is daydreaming. But I think reasonable improvement over a long run will be a material gain for a lot of businesses. Then telecom, technology, other such opportunities. One area which has gained tremendously in this period, it is that. And I think larger footprint, not just telecom, but the data and the digitization and the interlinkages with the commerce, interlinkages with entertainment and the other technology. There are staggering opportunities. So I would say it is the job of an investor to find opportunities. It is the job of investor to be worried about threats. And it is constantly an important task on an investor to balance the two, to remain watchful and mindful of the threats, as well as to remain positive about opportunities and to weaving into the portfolio, risk measurement, control of in the balance of the portfolio. That's where I see where things are on the long run.
Okay, focus on opportunities. Prashant, the last time that we spoke and the only time that we spoke on Alpha Moguls, you had spoken about how you are going out to choose your businesses, which is put them into a capital light and a capital heavy bucket and then try and go about choosing. Are you doing that right now as well? And if that is indeed the framework, what is standing out as a clear opportunity what is standing out as a void? If you can throw some light there. Prashant, you're on mute. You will have to unmute yourself.
I must say I'm impressed. It's been a long while, Neeraj, since we last chatted, and you do remember that capital light framework, or what we call clear framework. So we have always done that and continue. The team continues to do that. And not to repeat everything that Bharat said, but there are great businesses in every sector. Even in the sector may be considered as good sector or bad sector or okay sector, but within the sector, there's a complete range of businesses. It is not a homogeneous sector, right? So the team's job is basically to keep hunting and looking for what we deem great businesses, which have these attributes of superior returns on incremental capital, which would then deliver the capital light free cash flow, right? Because for that cost, the return on incremental capital has to be higher than cost of capital. So we are always looking for these businesses that are either dominant franchises or leadership role in their sectors, which are gaining market share on back of strong execution by the management, and delivering this growth and cash flow with robust corporate governance at all times. And we would only seek to invest if they are available at significant discount to what we deem as their fair value or intrinsic value, as determined by the capital light framework that you alluded to. And so we are able to, even at this time, like all other times, find these across sectors, be it domestically oriented sectors like consumer discretionary and staples or financials, or export oriented like IT services or pharmaceuticals or others. And even sectors like telecom that Bharat Bhai mentioned, there are opportunities across these sectors. I might add that there are certain areas where our philosophy tends not to find good investable opportunities over time. And those are typically, and not just in India, having managed money across global emerging markets in 30 countries, we've always struggled to find investment opportunities in government-owned entities and sectors where government ownership dominates the sector, be it like, and typically across the world, utilities and energy, like in India as well, tends to be dominated by government ownership. And that is no different as of today as well. We don't have much, if at all, in fact, none exposure over there. And the reason is because nowhere in the world, and I'm not singling out India for this, but nowhere in the world have we found that government-owned entities and their managements being worried about maximizing return on invested capital. They have a different charter, they have different goals. I'm not arguing they're bad. They are inclined towards greater public service. So in my mind, this is a government-owned entities or equities are a separate asset class altogether. They have been mixed together with private equities or listed equities of private companies. But in fact, just like we have debt, we have equity, I'd like to think of this as a separate asset class, which is something we don't understand and tend to stay away from.
So which you're not touching even now. I mean, banks or some of the other divestment candidates, etc., all marketing companies, you're not touching them.
As we don't find anything attractive there, we'll never say never. But again, we find it difficult to invest in a company where management is not aligned to shareholder interests. So primarily driven by minority shareholder interests, because we are minority shareholders at the end of the day.
Now, just before I hand it over to Kamal, I have one last question and I only have 2 minutes. So I would urge both of you to take a minute each and tell me about that one key risk that you believe could hamper the market. So Mr. Shah, to you first, to your mind, the one key risk, but I have 1 minute for the answer. The one key risk to your mind.
Well, right now we have mother of all the risks.
Which is COVID, so beyond COVID.
So I think my imagination is limited, and
Okay.
I'm able to think of any greater challenge or a difficulty than what COVID has thrown up. There will be surely residual or a kind of so to say, emanating after effects of a shock of this kind. So this has been earthquake, and there will be remnants, but remnants should, I hope remnants don't become new major earthquake like a force. At least I can't see any, but that may be because my imagination is limited.
No, you're just being too modest right now. Chan, let me ask you a specific. If you have a definite risk in mind, then great. But I was listening to the Howard Marks moderated conversation wherein the Oak Tree team believed that the shadow banking crisis in India is the bigger risk than COVID-19. Any risk
Sorry,
that you
what
believe?
is the bigger risk, you say?
So they said that the shadow banking risk situation in India is a bigger risk than COVID-19. That will be the headline. That was Oak Tree's
I'll
view.
just give
Howard
a
Marks.
quick half a minute response
Okay,
to that.
sure.
These generalizations people are fond of making. Whoever makes those generalizations, whatever may be the background and whatever may be the level of understanding, whatever may have been done by them in whatever parts of the world, all of these from any, including me, they should be taken with a lot of pinch of salt.
Bag of salt, Bharat bhai, bag of salt. Big 50 kg bag of salt. And I would just second that, Neeraj, just one second.
Prashant.
We oftentimes in India fancy these famous investors from worldwide and take whatever they have to say about anything and everything as a gospel. Particularly, I find it, surprising that we even take their comments about India as gospel. And I would just say that at one time I had I was, at Goldman, for many years, and I was heading the business here in India. But oftentimes, as happens in these multinational corporations, decisions are driven by New York. I once told senior management, look, you guys are much smarter than I can ever aspire or imagine myself to be. But we on the ground have an advantage of knowledge. On the ground knowledge, which they can't have. I mean, some management don't even know. I mean, I was once asked, how long is the flight from Mumbai to Bombay? Right? Because they keep hearing Mumbai, Bombay. And then they end up, they're far smarter, but with this limited knowledge, they end up making, conclusions about India, which can be fairly far from reality.
Okay. Well,
And
that
to
answers.
support his point, one of the biggest investors in the world, Buffett, why is he chosen to remain in his area of Karma Bhumi? He has rarely ventured to make any investments outside. Not that he, surely with his formidable talent, he could have done it in many other parts. But he has chosen deliberately to circumscribe himself because he finds it adequate enough in his own area. So I think what Prashant is saying has a lot of merit and fundamental force behind.
Okay, fair call. Thanks, gentlemen. And Kamal, you want to take it over now for the Q&A?
Yeah, thank you so much, Neeraj. What a wonderful moderation. I think most of the questions have already been answered, but I had a couple of questions. So if for next 4 to 5 minutes, I'll just try and ask those questions. First of all, let me tell you, I had to take this webinar from the rooftop because today is my daughter's birthday, and there's a birthday party going on. So this is limitation of working from home. So not everything can be done from home. So coming on to Bharat Bhai, in the last event which we had done in Mumbai, I had heard from you. You had mentioned that equity markets cannot be impacted monolithically, which is cannot be impacted by a single one factor. Bharat Bhai, you had mentioned that. But today it seems, and most of us believe, most of the investors believe that equity markets are just rising because of liquidity. There is an acronym which is becoming popular with everyone. It's basically liquidity which is driving the markets. Do you agree with this? Or if you not agree, what are the factors which you think are being missed, which people are not seeing and are responsible for markets to rise?
So without any question, ultimately merits and the economic fundamentals of a business need a catalyst in form of backing it with money for the price to rise. Even if there are fundamentals and more than adequacy of it, but money is not backing it, prices will not remain supported or they may fall. And equally, when there is too much money then for the same level of merits, the price may rise more than disproportionately. So that's there is no gainsaying in that. It's a basic fundamental truth. In near term, it is possible that money may be keeping markets at a level higher than what it otherwise could be. But whether I can ascertain that, I have no means to be able to make such assertions either way. Whether money is making markets go up, or it is basically finally people figuring out the right courage and to be able to bring their liquidity with they kept it hidden. That may be bringing it out. I have no means of knowing. I will still repeat that these generalizations unfortunately take us away from the task of what is essentially investing all about, which is to find good businesses run by quality people, enjoying trust of their customers, businesses which will grow at a right pace and in a right qualitative manner. And we as investors have to be prudent and disciplined to buy them at sensible price. This is what investing is all about. All other things that we mix up essentially is because we flirt and we want to entertain our own troubled minds with the issues around. Otherwise, COVID or no COVID, major challenge or no challenge, history of the businesses, history of economy, and history of the market shows that eventually after every such challenge, there is an opportunity. Then this particular challenge, as much as I can see, is probably of a near-term variety. It is, if I'm wrong about it, then it will reflect. But as I can see today, as much as I can understand it today, I think it's a near-term challenge. It's not a permanent challenge. And to that extent, we cannot convert temporary or a short-term challenge into a permanent damage. So rather than trying to find whether foreigners are buying or foreigners are selling, whether liquidity is gushing or it is withdrawing, whether this or that, these are merely attempts to entertain our minds in the troubled market scenario. But all that is unimportant. I think job of a serious investor is to find opportunities. And we can't get cowed down by the challenges. We have to remain legitimately be afraid of challenges. We have to remain legitimately be watchful of the threats and the concerns. And we can't become so confident that we believe that everything we know and everything is certain in our eyes. But having done all of these, where we see sensibly opportunities and where we see that markets are probably not fully aligned to recognizing that opportunity, it is our job, it is our dharma to make it and to go for it rather than get consumed by the corroding nervousness or the corroding worries.
Right. Thank you so much. Prashant, whenever I've heard you, you have always stressed on the risk management part that WhiteOAK Capital, takes care of. So you have always, highlighted your each and every team member, their skill set, everyone covering sectors. So, and you have always conveyed that quality is important, but value, buying that at a value is also equally important. So when Bharat Bhai has spoken about investor being very cautious about opportunities, and he's discussed few sectors like telecom, insurance, where there are opportunities. So if I were to ask you, what are the stress areas, what are the threats in terms of sectors, what are the points of caution which investors should be worried about, and if at all you want to kind of give any risk disclaimers in this regards, over to you.
Certainly. Thanks, Amal, and thanks for sharing your time. And I feel sorry that you have to take time away from your daughter's birthday. Hopefully, we can conclude in time so as to it doesn't get delayed. What I would say that when you ask about the risk part, the risk, the way we see it, is trying to do stuff where we have no skill set or nobody has any skills. What I mean by that, I've always said that the bane of our industry is that managers who themselves believe themselves to be stock pickers, they end up being quasi macro investors or market timers. So the way we think of risk is, if we end up doing things where non-stock specific factors, if you will, or drivers are driving returns. As long as stock specific risk is driving returns and performance, we consider ourselves to be well balanced from a risk perspective. Hence, we consciously stay away from betting on macro factors, or market timing is one kind of macro factor. If you're betting on market to go up or go down, that is a big risk you are taking in the portfolio. That is the single factor then that would drive the performance of your portfolio. If you're betting the market's going to go down because of COVID or whatever, then that, and if you reflect that in your portfolio by owning all the, or shifting to all the defensive sectors and defensive names which would hold up better in a COVID worst case scenario, then what happens if the scenario is the other way around, right? You've completely destroyed the team's performance for a long time to come. And that is the risk that we want to avoid. So if in the portfolio, hence, as I was saying earlier, we look for opportunities from almost every sector. We do not run after any single theme, because theme-based investing is another form of macro investing, which predisposes the portfolio to unwarranted risks which don't add any value. So staying away, to us, the macro factors are like coin flipping. Market timing, if you were to take as one macro factor, it is like no different from coin flipping, in the sense that someone can do, and there are a lot of people who do PhDs in coin flipping and a lot of people who do PhDs in market timing. Neither of them are any better than the layman in predicting the outcome of the next coin flip or where the market is headed. And so the two are very similar, and we don't want to take the coin flip risk in the portfolio. And similarly, any top-down sector rotation, that banking is good, IT is bad, XYZ's sector is good and the other sector is bad, those are closer to coin flipping. Whereas stock picking also has uncertainties, to be clear. It's not that everything is guaranteed in stock picking, but that is a different nature of, or different kind of game of chance. It is, if I were to continue to give the analogy of gaming, it's like playing bridge. In any particular round of bridge, you can get it, your team can get a terrible end of cards and you would lose, the other team would win. But in an evening or over a series of evenings, the luck factor, the chance factor evens out. And how much you win, whether you win or lose, would be a function of your skill set in playing the game. So that is what stock picking is. If you have a portfolio of several names, then through time, if you're doing your job right, you'd be able to beat the market over time. Just like Bharat Bhai has done over an extended period of time. What we didn't talk about, what we talked about is what the market has done over the last 5 years, 10 years and whatnot, which is close to zilch. But what we didn't talk about is what some of the good managers have done over the last 5, 10, 15 years, like ASK has done under Bharat Bhai's leadership, like WhiteOAK has done, where we've been able to deliver 5, 6, 7, or even 10 percentage points higher than the market by focusing on what we understand, where we have the skill, which is the analogous of playing bridge, which is stock picking, and staying away from the risks like coin flipping and macro, where there is no skill set that can be developed by nature of the beast. So recognizing that is very critical to managing that risk.
Right. Thank you, Prashant. I think I will have to, hear it again. It was so interesting and so insightful. I think you're talking about, investor behavior in a very scientific manner, to explain risk. My question for Bharat.
I would add, the problem, just as I said, the bane of the mutual fund manager industry, why fund managers worldwide on average underperform, is because they focus too much on macro. And they're quasi-macro investors, which is at best a zero-sum game. And after transaction costs and brokerage commissions, it leads to negative returns. On top of that, you have fund fees, right? So that's why the average fund globally tends to underperform. Similarly, the individual investor also should be cognizant of this risk. They focus so much on whether this is the right time to enter the market, whether this is right time to exit the market and whatnot, they end up doing more damage to themselves. Rather, they ought to be focused on selecting with advisors like yourselves, if you will, selecting which is the right manager to invest in, or if they have the capability, selecting which is the right stock company to invest in, rather than worrying about where the market is headed.
Our pitch always to investors is that, like fund manager is very good in selecting companies and stocks. We try to build our capability in selecting the fund manager. So absolutely, bang on that. And I can tell you, on this chatbot, you can see there are so many questions that have come, and most questions are about trying to find out the fate of equity market. And I think one point answer you already given to all of them is it's like, coin flipping. So nobody can, know it's either it's head or tail. So focus should be not on that, but should be on the, picking right quality businesses.
And oftentimes investors believe that good fund managers know which way the market is headed. This is the biggest fallacy. It's like thinking, even though Virat Kohli may be the best cricket captain, you cannot expect Virat Kohli to win the coin toss, no matter how important the game.
Yeah, true. So this one last question for Bharat.
Bharat, your phone is muted.
And just to add to what Prashant was saying, not only coin flipping often ends up sounding or being professed as investing, but we must recognize, like Buffett had once mentioned some 40, 50 years back, that when you do coin flipping, there will be occasions wherein 10 coins in a row or 20 coins in a row will turn out to be one way. And that will give you an illusion that it was a skill rather than a chance.
Absolutely.
But skill and chance are properly evaluated only over a meaningful period of time and by consistency of practice, not merely profession.
Awesome.
Absolutely.
One last question, from again, putting myself in investor's shoe. Bharat bhai, this question is for you. This is, generally extremely difficult for investors to remain invested into a quality stock. So now when we are concentrating on not talking about market, not worrying about market, worrying about focusing on the opportunities of quality businesses. We have picked quality businesses. We have built a good portfolio. Now, you have in your strength, having managed, ASK's portfolios where last 10 years returns are almost, 13 to 14% year on year. Despite last 10 year indices giving only single digit return in maybe, 2, 3, 4%. As we discussed in earlier conversation. So what is it that gives you, so much patience to remain invested into a quality stock? We have seen examples, so many examples. I see your portfolio. I have seen a portfolio, 7 years ago, 6 years ago, 6 months ago. It remains almost, always remains more or less same. How do you stick to those stocks, seeing them rising?
Well, 3, 4 points there. One, nothing is permanent, and therefore we can't fall in love with anything that we own. As investors, much like markets don't have any emotion, we can't have any emotions about anything beyond the economic interest to be derived from the stocks. So therefore, it is duty to remain watchful forever, even if we think and we can appraise and appreciate the merits of a business that we are owning. So long as those merits remain, we have to remain in love and bondage with those names. So, sorry. So that's one. Second, quality is so rare. It is an exception rather than a rule. And lack of quality in general is a rule rather than an exception. Thirdly, if you look at it over a prolonged period of time, not any artificially sliced and diced particular slice of a time in which one result or the other can be contrived to look as a representation of reality. But when you look over a proper cycle with one bear and one bull phase on a proper full cycle, you will realize only quality can compound. Inferior businesses by definition are standing on very narrow legs. It is like having in a four-legged stool, having only one or two legs to stand on. And therefore, inferior businesses fundamentally can create returns only from point A to point B. It cannot create compounding returns. Compounding returns by definition can only come from the quality businesses, which can, by definition, can keep compounding like machine over a long period of time. Third, one of the illusions that we get carried away by is overimportance of the growth. Therefore, there is a near-term bias about preferring growth at the expense of many other factors. Once you are able to take away that bias that you have to hunt for highest growth in the near term, but rather prefer reasonable but surer, qualitatively sound one and long-term growth, once you are able to ascertain that fact in the mind, then you are able to get away from the temptation of falling for chasing whatever is currently more favorable and currently more growth-oriented looking, even if it is otherwise debilitating kind of a growth. And finally, I would say that basically the real outsized returns do not come from the most profound stock picking. We may want to, as investors, many times we want to ascribe ourselves in halo and glory, and we want to talk about how good our stock picking is and what we have done, but far greater final results come from the temperament, discipline, and wisdom of investing. Of course, that doesn't mean that you can be a dullard and can do a good job of investing, but you don't need extraordinary capability or intellect or greatest stock picking for you to do the trick. More than with good enough stock picking and good enough intellect, but backed by strong sense of discipline and remaining true to the course rather than getting carried away, that has a far bigger impact on the finality of the scheme of things. And that by definition can only come from compounding businesses, and which by definition only quality can create. By definition, non-quality businesses can only be point A to point B businesses. It can never be compounding, and therefore the reason to stick behind it.
Thank you, Bharat Bhai. Thank you everyone. Thank you, Mr. Khemka. I think it has been a pleasure talking to you. Thank you everyone for joining. It was a wonderful, insightful, interesting discussion. And our view is also, being cautious, being, optimistic. And at the same time, we also propagate investors to invest in quality, be cognizant of risk, and invest for consistency. And with these words, I would like to say goodbye to all of you. Thank you.
Thank you, Kamal. Thank you, Bharat. Thanks, everyone.
Thank you, Prashant. And thank you, Kamal. Good to see all of you. And good to see you, Prashant, again.
Same here, Bharat.
Always a joy.